back. We're in the second piece of Chapter 5, which again deals with the bond market and Michigan's money and banking chapter. In this case, we're going to focus on what's referred to as the liquidity preference framework. So there's a couple key pieces to what this section really looks at. So first of all, it provides a linkage or a bridge between the bond market and the money market. And so we'll see that there's a very close relationship between the two. And what we'll do is we'll be able to understand several different things and how they all fit in together to understand the linkages of the money market and the bond market. And then later on, what we'll see too is how impacts of, say, changes in the money supply can spill over into the bond market and vice versa, and ultimately say something about the impact and efficacy of monetary policy changes. But to set the stage a little bit, first of all, this is really a basic model that Keynes sort of came up with, John Maynard Keynes. So Keynes viewed money as an asset, and he also had this simple view of the world in which we could have two basic assets, bonds and money. And so that's really the genesis of where this model comes from. So in a simplified world with those two assets of money and bonds, then what this does is it sets up this choice in terms of how you choose to hold your wealth. Do you want to hold it in money or in bonds or vice versa? And what we'll see is there's going to be somewhat of a trade-off in that. And so this liquidity preference framework that Keynes came up with, again, is a pretty simple way of thinking about the world. So the idea here is that we have two assets, money and bonds. And so we can simply choose to hold our wealth in either of those two forms of bonds. Now, granted, the real world has a lot more assets and there's a lot more choice involved, but this sort of simplifies it so we can get to the essence of these linkages, these important and pretty strong linkages between the bond and the money side of the economy. So the idea here is that we have these assets out there. People can choose to hold their wealth in either of these two forms of assets. They can hold it in bonds, they can hold it in money, or they can hold it in a little bit of each. And more generally, not surprisingly, the amount of assets that are floating out there, the supply of those assets has to be equal to how much people want to hold, right? And so if there's not, there's going to be an equilibrium occurring, and we'll eventually get to that asset equilibrium, so to speak. And so what that means is that in the case of our supply of assets, again, in our simplified two-asset world, it's got to be the case that the supply of bonds plus the supply of money has to equal the demand for money plus the demand for bonds. So we have the supply of assets out there and the demand for assets out there. Somehow those two things have to match up, okay? And we can rearrange this in a slightly different way such that, let me just be a little more precise here. If we subtract the demand side for money over to the left-hand side and subtract the supply side, of bonds over to the right-hand side, then this tells us something really important, which also gets at the heart of this linkage between bonds and money. Here, we have this money supply and money demand, okay? And I'll talk about exactly what that means here in a minute. But for the moment, this really sets up the money market, okay? And so in an equilibrium in the money market, the difference between those two things is going to be equal to zero, right? So if the money market is in equilibrium, that is, money supply is equal to money demand, then it has to be the case that the bond market also is going to be in an equilibrium. That is, the demand for the demand for bonds is equal to the supply of bonds, okay? Likewise, you can play around with this and see that, well, if we have an excess supply in the money market, we're going to have an excess demand in the bond market and vice versa, okay? So these are some really important linkages that we're going to play around with here momentarily. And so these are going to be important to look at these things sort of simultaneously for a variety of reasons. But you might be asking yourself the question of, well, why are we playing around with both? Why don't we just focus on either one market or the other market to get at the heart of the results? It turns out that for changes in expected inflation, as we saw in previous videos, it's easier to think about that in terms of how it impacts the bond market, okay? But then there's going to be other factors which are going to be at play, which we're going to want to take account of, which are easier to account for in the money market. And so because of that, we're going to be playing around with both of these markets sort of at the same time to get to different issues of the same overall concept, which is understanding the impact on interest rates. Okay. So having said that, let's look at what's referred to as the money market. Now, before we talk about this, there's a couple of caveats that we have to mention here. When we're talking about the money market here, we're literally talking about the supply of money and the demand for money, which we'll define in a second. This is a somewhat different notion than a financial market notion of the money market, which refers more generally to short-term credit instruments, okay? So here, with the money market, we're talking about money supply and money demand, just like any other market, okay? So the money supply as we all know, or if we don't, we'll find out soon enough, is going to be controlled by the Fed, right? So the Federal Reserve, they conduct monetary policy, they conduct what's referred to as open market operations, and we'll see in detail later on exactly the process of how that works. But effectively, they can push and pull money into and out of circulation, and the way that they do that is, as it turns out, through open market operations by buying and selling bonds. And so by conducting these monetary policy changes, that changes the mix of bonds and money in circulation, and therefore has important impacts on interest rates. And so for that reason, it's important, again, to understand the linkages between the money supply, the money market and the bond market. And so it turns out that the money supply, that is the amount of money that the Fed issues, is going to be perfectly vertical, okay? Now what that means, and we'll see this in a graph in just a second, is that the Fed issues money supply and it's completely independent of what the interest rate is. Now that may sound counterintuitive because one of the things that the Fed, at least in the recent past, has done is control interest rates. It turns out that's an equilibrium effect through both the money supply and demand process occurring, okay? So what this means is that our money supply, if we're measuring the quantity of money on the horizontal axis and the nominal interest rate on the vertical axis, our money supply function is going to be perfectly vertical. That is, the Fed just dumps some amount of money that it determines into the economy, and it can do so regardless of the interest rate. It can put that amount of money in there. So that's the money supply, and that's fairly straightforward. The second piece of the puzzle is money demand, okay? And so you might think to yourself, oh, money demand. Yeah, I want as much money as I possibly can. Now, that's not the intuition behind this model. The idea, again, is that everybody has a fixed amount of wealth or a fixed amount of income. And so the question is, what are you going to do with that income? How do you choose to hold that amount of income or wealth in terms of your balance of assets? In this simple Keynesian world, we can either hold it in terms of money or in terms of bonds, okay? And so as it turns out, there's going to be this sort of trade-off here, because if we choose to hold our wealth in the form of bonds, that earns a return, and therefore as the return goes up, you would expect people to want to hold less money and more bonds, okay? And so because of this, there's an opportunity cost for holding money, which is the nominal interest rate. As the interest rate rises, the return on holding bonds goes up. People want to hold more bonds and less money, okay? And so because of that, money demand is inversely related to the nominal interest rate. And so again, we can draw a simple graph in which we have this downward sloping relationship. Okay. Again, as the nominal interest rate rises, the return on holding bonds goes up. People want to hold more bonds, and therefore the quantity demanded of money, that is how much money people desire to hold, goes down. So if we look at an equilibrium, again, you've seen this before in many, many forms. Whoops. We call our money supply curve. See, now I'm getting this all messed up. Our money supply curve, remember, is perfectly vertical, and money demand is downward sloping. So our equilibrium then is just going to be where supply is equal to demand, just like any other equilibrium concept. Okay, and so the more important and perhaps interesting cases is to think about, what if we're not at that money market equilibrium, right? How do we get to that equilibrium? Well, natural market forces are going to push us there, okay? And this is where the bond market comes in, and it's easier to understand this process. So, for instance, if we're at an interest rate of I1, at that interest rate, I1 here, you have the amount of money people are forced to hold right there, right? That's the supply of money. That's the amount of money people would like to hold or desire to hold at that interest rate. So in this case, at the interest rate I1, the supply of money is greater than the demand for money, okay? People are holding more money than what they want. So what that means is they want to get rid of that money. And in particular, people are going to want to transform money into bonds, okay? And so what this means then is that the demand for bonds is going to go up. People want to dump their money and get into bonds. The demand for bonds goes up, okay? So imagine in your head a graph of the bond market. When demand goes up, what happens to price? Price goes up, right? And when price goes up for bonds, what happens to the interest rate? Remember the inverse relationship, price goes up, interest rate goes down. So through the bond market, and again, you can sketch this out on your own, that's going to lead to interest rates falling. So as this excess supply of money and excess demand for bonds continues, that gap is going to continue to fall as the interest rate goes down, okay, until we end up at that interest rate here. We can tell a similar story if we're on the bottom end of that, okay, it's completely analogous. If we're at an interest rate of I2 here, what that means is that people want to hold more money than what's available for them to hold as an asset, right? So at that case, you have money demand greater than money supply, right? So what that means is that people are going to liquidate some of their bond holdings so that they can get into the money that they want. So when they're liquidating those bond holdings, right, they're getting rid of their bonds. That pushes up the supply of bonds, or the demand goes down, one or the other. That's going to lead to a decline in the price of bonds. And that means the interest rate is going to go up. As the interest rate rises, that gap closes until we reach equilibrium. Okay. So perhaps the more important part of this story is thinking about what happens once our equilibrium changes here, okay? And so there's two basic things that we can look at. We can look at demand side changes and supply side changes. So first of all, there's a couple different pieces of the puzzle here in terms of things that could affect the demand for money. The first is, say, income, right? So the idea here is that if income goes up, people want to buy more goods and services, and of course you need money to be able to buy more goods and services. And so because of that, we want to buy more stuff, and therefore we need more money to do that. That means you would expect money demand to go up. So if income increases in this case, money demand is going to rise and vice versa, okay? The second effect is what's referred to as a price level effect, okay? Suppose, say, the overall price level goes up. So there's a one-time increase in prices. In a case, again, assuming that you want to buy the same amount of goods and services that you were before, if prices simply just went up, then in order to buy the same amount of goods and services that you did before, you need more dollars. You need more money to be able to do that. And so what that means then is that in order to keep maintaining that same level of purchasing, you're going to have to hold more money to be able to make those transactions take place. So as the price level goes up, you would expect, again, an increase in the demand for money. Now we can see, if we look at what that looks like in equilibrium, in either of these cases, these two examples here, it's sort of the same. What you get with an increase in money demand, that money demand curve shifts up. At any given interest rate, money demand rises. And so our equilibrium interest rate in either of these examples is going to go up. Okay. So these are the basic things that are going to impact money demand. Now, what we'll spend a lot more time on later on, of course, is talking about monetary policy. And so this is sort of the beginning of looking at a much more complicated approach to monetary policy, but let's look at the supply of money. So in this case, as I said before, I believe that the Fed controls the supply of money, and they do that through open market operations. We'll see more in more detail exactly how that works, but for now, let's suppose that the Fed decides to, say, increase the money supply, okay? So they can just wave their magic wand, push and pull their policy levers, and voila, there's an increase in the money supply. So again, it's not too hard to see in this basic money market equilibrium what's going to happen at any given interest rate. You should expect the supply of money to go up, and therefore, as a result, we move from A to B, and the interest rate falls. Okay, this policy here would be what is considered an expansionary monetary policy or an easing of monetary policy, as the case may be. And of course, if the Fed wants to contract the money supply, a contractionary monetary policy, you would have the opposite effect, and interest rates would rise. Again, we'll take a lot closer look at that process in more detail. So in this case here, again, what's happening through this process here, just to sort of summarize, with this process of the money supply, when we have an increase in the money supply, as I said, through the so-called open market operations, on the back end, what the Fed is really doing is they're going to be putting money into circulation and pulling bonds out of circulation, okay? And so by that process of adjusting the mix of bonds and money in circulation, in this case, there's going to be a decrease in the amount of bonds in circulation through this process, right? That's going to bid up the price of bonds and hence down the interest rate. And again, you can see that's entirely equivalent to the story that we had here in this linkage between money and bonds. So that that's the important part of this, this segment, is to think about this linkage between the bond market and the money market, because they're sort of two sides of the same coin. And so the punchline then is that monetary policy has implication for altering that mix of bonds and money in the economy, and then also, of course, having important effects on the interest rate, which we'll spend a lot more time on later on talking about. Thank you.